Welcome and get ready to dive into the thrilling world of investments, where numbers dance, money talks, and the unexpected always keeps us on our toes. Bank of America released its latest earnings last week. While its earnings and revenues both top Street's estimates, the company's detailed financials showed that the bank faces a whopping $131.6 billion in unrealized losses, with about 25% of all held-to-maturity (HTM) securities possibly having little to no value. Today, we'll discuss the increasing unrealized losses affecting both small and major banks in the U.S. Underneath each major bank's record-high trading revenues, investors also see profits are dropping, and the situation is concerning. Okay, before we jump in, remember to subscribe to our channel to show us some support. You might be wondering, what's causing this massive ripple in the banking sector? It's been reported that there's a huge increase in unrealized losses. In just the third quarter, the losses on HTM securities grew by $26 billion, reaching a record of $131.6 billion. In June, it was around $100 billion. The Bank of America tried to offset the losses by selling $10 billion worth of assets, decreasing their total assets from $614 billion to $603 billion. However, a significant portion of these HTM securities remains valueless. Ideally, banks would hold on to these HTM securities until they mature, which could range from a decade to even 30 years. By design, these securities will be deemed at par value at maturity. So why do banks decide to not hold these to maturity? That is because when there is massive deposit outflows and declining profits, banks are forced to sell them early so they have enough liquidity on hand. This situation reminds many of the 2008 financial crisis. Since last March, investors have been closely monitoring these unrealized losses. Unrealized losses have come under closer scrutiny by investors. Remember, at the time, Silicon Valley Bank sold a portfolio of its holdings at a sharp loss, precipitating its collapse and fueling the worst industry turmoil since the 2008 financial crisis. When Silicon Valley Bank faced outflow pressure, it liquidated part of its HTM securities at a significant discount. We all know what happened next. You may be wondering what these securities were. Well, they are mainly residential mortgages or bonds. When those securities were bought by SVB, they had interest rates of 2 to 3%. But as current rates for 10 to 20 years surged between 5 to 8%, these 2 to 3% coupon bonds were trading at a very large discount to par. Why would big investors choose a tiny 2 to 3% return when they can get newer bonds paying 7 to 8%? Silicon Valley Bank mismatched their duration, so they paid the ultimate price. But the same problem exists everywhere in the financial system. Virtually all banks, large or small, had those bonds on their book at a large discount. The potential unrealized losses for U.S. banks could reach an alarming $650 billion, a 15% increase from the second quarter's end. U.S. banks could be grappling with at least $650 billion of unrealized losses in their securities portfolios. That's as a result of prospects of interest rates staying higher for longer led to a bond market rout in the third quarter. That would be 15% more than the $558 billion of losses they were sitting on at the end of the second quarter. Bank of America's CEO recently expressed confidence in not realizing losses on their HTM securities. Zero Hedge tweeted, he does not expect to ever realize losses on $600 billion in HTM securities, means he has explicit assurance from the Fed it will buy its impaired debt at par in the next crisis. It seems there might be a backup plan involving the Federal Reserve buying the troubled debt at its face value. But who pays for such a bailout? Possibly the taxpayers. It raises ethical concerns, especially when these banks face shrinking profits and deposits. Industry giant Goldman Sachs is also in a tight spot. Reports indicate a reduction of 1/3 in their profits. As Investor Turf tweeted saying, Goldman Sachs witnesses a 1/3 decline in earnings. Goldman Sachs has disclosed a 33% decrease in third quarter earnings, attributing it to subdued market conditions resulting in fewer deals for the US-based investment bank. Additionally, the bank experienced a significant increase in expenses during the quarter, primarily related to writing down its investments in lending platform GreenSky and real estate holdings. Plus, they've encountered rising expenses mainly due to impaired investments. And while Goldman Sachs might boast of $2 billion in profits, if their unrealized losses surged by $30 billion, their profits would be overshadowed. Furthermore, Morgan Stanley is also feeling the pinch. Following their recent earnings announcement, their shares plummeted 7.5%, as tweeted by Gurgavin. Interestingly, the financial narrative is shifting. It's no longer about smaller regional banks. The big players are now under the microscope. And the banking distress doesn't end with these banks. Charles Schwab, a banking titan, has faced a tempest recently. Schwab's profits have dropped by 30% within a year. Shockingly, their bank deposits have also decreased by 30%. Such trends hint that big banks may soon struggle for collateral against loans. If this persists, they may need to sell those loans to the Federal Reserve at drastically reduced prices or just break even. Analysts like Gurgavin haven't seen such a decline in Charles Schwab's profits since the 2008 financial crisis. Though they've witnessed a 30% drop in yearly profits, the foundation of these profits is shaky. The reason? Their securities held to mature are at risk of failing, which could decimate their profits. Adding to the alarm, Charles Schwab's unrealized losses relative to their equity capital are raising more concern. In Q1, these losses were 171% of their equity. Now, sources such as Peruvian Bull reveal this has surged to an astounding 329%. This means their unrealized losses are 3 times their total equity. For context, this is triple the ratio that Silicon Valley Bank had before it faced financial woes. Banks, traditionally the bedrock of financial stability, are showing signs of vulnerability. It's not just the smaller players or the regional banks feeling the pressure. Titans like Bank of America, Morgan Stanley, and Charles Schwab are facing dark clouds of uncertainty. Evidence of the brewing storm is clear. To stay afloat, these banks might be forced to part with their held-to-maturity (HTM) securities at severely discounted prices. This isn't a strategic move, it's about survival. When you're in the eye of the storm, anything non-essential is thrown away. Banks are taking drastic steps. The shutting down of physical branches, staff layoffs, cost-cutting on almost all fronts. It wasn't merely a bid to adapt to a digital age, it was a desperate gasp for financial breath. With declining profits, shrinking deposits, and evaporating cash reserves, their trajectory is worrying. For the average investor or the everyday individual, this spells trouble. Depleted cash reserves mean these banks may struggle to grant loans. The next logical step? A distressed sell-off of HTM securities. We're not just talking about small change, we're talking potential losses in the billions. Looking back, this looming crisis has shades of the 2008 financial catastrophe. But what we're potentially staring at is the 2023 financial whirlwind. With the year-end in sight, the question looms, will these banks come to terms with their unrealized losses? If so, the ripple effect on the global financial landscape could be seismic. If this analysis is resonating with you, consider subscribing. Join our InvestGrowthWisdom community and let's make sense of these market dynamics together. In conclusion, staying informed is key. Markets are volatile, but with the right knowledge, you can stay ahead of the curve. If you found value in this analysis, give us a thumbs up and remember to subscribe. Until next time, stay informed and stay ahead.